I had 5 different brokers say that we basically can't buy the house. I was going to give up on that deal. These are the brokers that I personally use for all of my property purchases.
65 flats for a 27 million. Value in the end was about 48 million.
They're going to be screwed on the end value.
Yeah.
It took us that long to track this guy down that was living in a van somewhere in Wales, and he had to get a private investigator to find out where he lived.
Wow. That due to the tax changes, it's very hard for a landlord to buy a family home and rent it and make profit. And buy to let is dead.
It will come back to bite you eventually. Bridging is the way to go if you're looking for the end value result.
How do you get a commercial valuation on a HMO?
You only get one shot.
Let me know if this sounds legal.
We'll save you £17,500.
We're here today with Dan and Marcus from Mortgage Style. These are the brokers that I personally use for all of my property purchases. Today, we're going to ask them all of the difficult questions that you guys want to know. So let's get straight into it. So what is it that you guys do at Mortgage Style?
Well, generally speaking, it's a bit of everything. So it's not just one specific thing. It can be residential mortgages. It can be sort of semi-commercial mortgages. It can be self-development. It can be development loans. There's no one thing we necessarily specialise in because I don't want to pigeonhole us into one area. But specifically, we're very good in terms of obviously HMO mortgages. We've just obviously won an award on that, which obviously you can see on our socials or on our website. We obviously delve into, as I said, the semi-commercial space, the commercial space, developments of HMOs, developments of properties into self-build mortgages, for example. A bit of everything, really, isn't it, Marcus? Yeah. To be honest. So we do a bit of everything. To be fair.
Cool. And what is a mortgage broker for anyone that doesn't know?
Well, it's just someone who helps you find the best deal possible, or most suitable deal for your circumstances to get you that property. So if we're talking about investment properties, you've got to be looking for the deal that really works and make the numbers work for you. So we'll shop around all the banks and building societies. We've got connections with private banks, private lenders, all sorts. So we do all that work for you. So it's an absolute nightmare. If you've got to do it yourself and shop around, go on the high street, it would take you weeks. Honestly, through us, we can do that for you, but we've also got exclusive deals. So even if you went to a bank, we can often get you a better deal than you could if you went direct to them.
Yeah, I'm with you. I'm with you.
Based on the level of business we do with them. Yeah. And it's the tenacious element as well that I think you get from a broker that you don't have for yourself. It's, obviously having the ability to go and find a deal, and I think you would testify for that as well with us that, we do go the extra mile to generally make a deal work for someone, and normally people give up before they get to us, and they get to us and they realise actually no, we could have done it. And that's the great thing about, I think, using a broker, to be honest.
Yeah, because we've done over 23 purchases together.
Exactly.
Refinances, I don't know, a lot.
And they're hard as well. I think the big thing is having the testament from a broker to be like, look, we're doing a deal, and that deal is generally going to work, and because you can trust me. And again, because we've done those deals and the amount of deals we have done, I'm sure there's been times in one or two of those deals where you've gone, is this going to happen? Is it not going to happen? Yeah. And it's just having that kind of trust in a broker to know that it will. Whereas if you're doing it on your own, you generally don't know. You're going through all the emotions, and it's just trying to keep you grounded. Whereas when you've got a broker dealing with it, you can go and do your day job, do whatever you want to do, and you come back and we're at an equilibrium point where we know that it's generally going to work. So I think that's the main thing.
I would say also we've got all the support staff. So we've got loads of administrators. So they deal with, on your behalf as the client, they'll be ringing up solicitors, surveyors, estate agents. They'll do all that for you as well. So it's just saving you time all over.
Yeah. I've personally tried about 5 different brokers before I met you guys, and there was one particular situation. I had a joint venture partner, and he was 20 years old. And Dan, you know this story, but just for the viewers, he was 20 years old, and I had 5 different brokers say that we basically can't buy the house. We can't get a mortgage on the house because we only had about 120k to work with, and the house was 170k. Great deal, actually one of my best deals I've ever done. But everyone was saying no. So 5 brokers were like, no, he's too young, because the minimum age requirement was like 21.
That was it.
And then you were like the 6th broker that I spoke to, and then you was like, right, let me look into it. And then you did get us the mortgage, so that really saved us on that one.
That was great.
I was going to give up on that deal.
I remember it. I remember because the main issues with that case were, just for the viewers and obviously anyone that is interested in that sort of thing, was experience, which was a big thing. Because obviously at that time, I think obviously the the joint venture partner didn't have as much experience as obviously what was needed, and also the age was the big thing, and then it was trying to combine that with commercial val. If you remember, the commercial valuation was the big thing that kind of, even though lenders might do it at the younger age and they bypass it or get around it, it's just having that wherewithal to obviously know that that's a thing. Because I think if we hadn't have done it that way, the only way we could have potentially done it is if you were like 80% director, he was not, well, 81% director as well, and he was maybe like a 19% just shareholder. That would have been the last resort. So there was still another way out of it potentially, but yeah, definitely, obviously one where we had to work to get it done.
Yeah, and I appreciate it, that because that deal there really set me up.
It was good.
Because it was like a more money out deal when we refinanced.
It was, and it was a commercial val on that one as well, I think, as well. So
we bought it for 170, spent 60k, and then it got valued at 335.
That's right, and that's probably even low, to be honest, because since we've obviously found the better valuers in the area, we've got much better valuations on those as well.
Yeah, but I just wanted to ask you guys, what would you say the main benefits are of using a mortgage broker? I know you touched on some points there. Are there any other benefits of using a broker?
I think speed, packaging the case, and obviously knowing where to go to start with. I think that's a big thing, because unless you set up your niche, obviously you know where you're going as obviously you might testify to the fact you know where you're going now, but that would have started from a broker and obviously knowing firsthand where to go. And obviously that might change. So I think direction is a main thing. Second thing, obviously, is just basically being able to deliver what you're asking for. That's really important. And the third thing I think really is just the coordination of everything together. So obviously knowing where you're going, what solicitor you want to use, okay, trying to put all those things together, and then like Marcus said, touching on the admin side, that's really important, because obviously we've also got other clients to deal with, but you don't get left behind because you've still got an administrator that will help you as well to help you boost through the process. So if you're doing it on your own, you'll testify for this as well. The amount of documentation you need to provide for a commercial valuation, it's crazy. You might as well give them your shoe size. So at the end of the day, I think having those things all together is really, really important.
Yeah, definitely.
I think adding to that as well, if things do unfortunately go wrong sometimes, and it's not necessarily the client's fault or the broker's fault. It could be a solicitor, it could be a estate agent, it could be anything, but things do unfortunately go wrong, and you want someone on your side who's going to help you and get you out of that hole. And that's what a broker does, a good broker.
And it's having your niches as well, because like you might be a certain type of investor that looks at HMOs. You might be a certain type of investor that does purely self-builds. You might be an investor that does a bit of everything. So if you've got someone that obviously knows a bit of everything about everything, then obviously it makes the whole process a lot smoother, a lot better in terms of just getting to the end goal, really.
Yeah, I think for me, big reason for me is I don't want to shop around and speak with 7 different lenders. I'd rather come to you, say, look, this is the deal, here's the address, here's the details. Can you find me the best deal? Because we don't just use one bank, we don't just use one mortgage company. Because there was this older guy who's like a big developer, and his biggest tip for me was don't just use one bank, use multiple different banks for your portfolio. Because if one of them goes bust, then you're kind of screwed.
You can diversify against it, can't you? Yeah, exactly. Yeah. And also as well, the more you put with one lender, the more vigorous testing they put you under as well. Because you take some lenders in particular, they might want more information, more personal interviews with you, more things that maybe even cash flow projections, things like that are a little bit different, especially with the commercial lenders anyway.
Yeah, and I think the admin element as well, that's another big reason why I use a broker and I use you guys, because you've got a dedicated admin team.
That's it.
That can handle as much as possible. Bits that I need to do, I'll still do them, but it definitely takes some of the heat off me and my admin team.
100%.
So super common question that I get is social housing mortgages. People asking me, am I eligible? Can I get a social housing mortgage? I've had some people tell me that, the requirements, what I've told them that they need, they're saying they've heard otherwise.
Yeah.
So what is the situation with that?
It's a big myth. I think that there's definitely a lot more needed in terms of that kind of sector. It's funny because you go up in the spectrums and it gets harder and harder, not to a point where you can't do it, but there are more restrictions. It's a bit like you need to have certain requirements for each individual kind of sector. So you start with buy-to-let first. I know your question was obviously go into this social housing part, but I think it's important that your viewers know how to get to that point, because a lot of people like yourself would have started maybe with just one buy-to-let, and it would have been maybe a residential they converted into a buy-to-let as well. So it's not you're an accidental landlord as well there, so you haven't even specifically gone into that. So you start with like buy-to-lets. It's a nicety to have 25 grand income. It's a nicety to obviously own a house, and it's a, probably a nicety to also have a buy-to-let you've let out for a year for all lenders. But those doors will get knocked down obviously as they go through. So if you go to like HMOs, for example, generally, and this is generally speaking, again, it's nicety to have all those elements I've just discussed. But the main difference with a HMO is that some of them might want you to have a year's or 2 years experience of letting a property, not necessarily HMO. And then if you get to 7 beds, it might be that they want a similar sized property for a commercial valuation. But that isn't necessarily true for all lenders. So you've got a couple of lenders in the HMO space that are generally pretty good in terms of commercial val. There's one that will do bricks and mortar val. So one of either, the lower rates for the bricks and mortar, the higher rate for the commercial val. And generally they don't need you to have any experience. If anything, you could buy a buy a property on a bridge, do it up, then come back to them to refinance for the effectively the refurbished side, and then get the higher valuation on bricks and mortar or commercial HMO up to 6 bed. If you go 7 bed, that's when we get tailored to maybe having to have a year's worth of experience, and it becomes a difficult kind of entity to have that and also the commercial val. Two kind of things together are kind of toxic. So you really want a business partner that's obviously got an HMO before or ready to come into that with you, or effectively maybe an exception basis. If you're earning decent money, we can still potentially get around it, but we're talking probably 50k plus if you're going to do that potentially. I'm not going to circumvent that and say you can't below, and I don't want to, because I think there are exceptional circumstances, but that point is really important. And if you get to the social housing side, again, that is different level complexity, because it's kind of going up in that kind of scenario. So the social housing is harder, generally to get. It is more restrictive. Generally, if you want a commercial val with that, that is more difficult, and you're generally only going to be getting 65% loan to value, generally. But the main kind of things are, you generally need to have a residential home. That helps. You need to have a buy-to-let. That also helps, renting out for a year. And if you don't have those things, then you need to have a JV partner that has a couple of those points that I've just raised, because that can bypass it. So if you bring on another party, even if they've only got a 1% shareholding, as long as they've got that experience, they're willing to come onto the application with you for that benefit, whatever you decide to provide them with, obviously cashback or whatever it might be. But if they can provide you with that experience, then that's how you get into it, and that's where you come into play, because obviously you can offer that to your clients or anyone that you know as well. So that's also a benefit if that can work out between you and any business partners.
So just going back to that, if someone's purchased a HMO property and they want to lease it to social housing, is it like a set in stone thing that they're going to need HMO experience, 1 or 2? Is it 1 buy to let?
So like the genuine rules for most lenders, so there's like not very many lenders that do it in the first place anyway. So I'm trying to kind of get it all together in one, but kind of tell you like 4 or 5 different lenders' policies at the same time. So to kind of keep it clear, the least amount that you can possibly have is nothing, because obviously a JV partner like yourself could come involved and obviously get part of that deal. The next part would generally be if they could have at least a year's worth of buy-to-let experience and own no residential property, no minimum income really, just some form of income, then they could still do it.
So
it's
HMO
that year's
experience?
No HMO, just 1 bog standard buy-to-let. And any buy-to-let, even if you'd bought it to live in, then rented it out, that could still classify as a year's worth of experience, for example. But it's when you try and combine that with commercial val that it then becomes difficult.
Oh, if you've got a HMO, you need a social housing mortgage, but now you want a commercial val.
That's the difficulty.
It becomes more stricter.
Because when we're doing it, generally, we are able to circumvent you to a lender and also hopefully a valuer, within reason of what a lender can provide you with, like we do with your deals. But if you want ultimate control, which is commercial val and also, effectively the valuation you're hoping for and the rate you want and everything together in a kind of a nice bundle, unless you have, obviously going to have like a year's worth of social housing experience as well, which is a bit of a chicken and egg situation because you got it, but obviously other people might not have it. If you don't have it, it's harder to then get the commercial val, and that's the difficulty.
I'm with you. Okay, so generally, if someone they're about to buy a HMO, if they've got say 1 buy to let, they've got HMO experience, and they've got a residential home, they should be eligible.
That'd be fine. Yeah.
What about credit?
That's another question. Do you want to answer that one, Marcus?
It varies again between lenders. So some will say, no, can't have missed a payment on anything, even your credit card over the last 3 years.
Damn, I'm screwed then.
But having said that, there's loads out there who are more flexible. And, we've got lenders, you can have missed a couple of payments right up until the month before you're applying for the mortgage on stuff. So it really is a case of us looking at your credit file, what have you got on there, and then compare that to what the lender's criteria is, and we'll find a space for it, basically.
Yeah. And if someone's got really bad credit, say if they've just got a low score, can they get a mortgage?
Score's like irrelevant, really. I think you probably agree with that. Like, score helps, like, but it is kind of one of those myths that we'll probably get onto later that you want to talk about. Like, I think the funniest thing about scoring is that if you're going mainstream, so you're going to Halifax or Santander or you know, someone like that are generally a residential mainstream lender, and you're getting a residential mortgage to live in house-wise, then that is one where you will have trouble with score. Right, but if you're going off the market and you're going commercial valuations, you're going buy-to-let, you know, kind of HMOs, you're going, you know, that sort of thing. Score is important, but it's not like they're looking at that and going, that's when we're going to do a deal because your score's over 900. They're not doing that. It's generally, have you missed any mortgage payments? Have you missed any, you know, kind of credit card payments? Have you got a CCJ, a bankruptcy, a default? If you haven't got any of those, but your score's just low because you haven't got a lot of credit, that's not going to be a problem.
No.
It's really when, you know, you're going for a residential mortgage where you're living in the property, that score is really important.
Okay.
When you're doing buy-to-let, it is important. I'm not saying, like, you know, miss payments and have big issues, but as long as you haven't missed payments, you shouldn't really worry, to be honest. That's my kind of view, really. I mean, look, you know, you go to some lenders like a TMW or a BM, and I think you can kind of say that they are quite hard to pass credit score with, but they are like top. There's still lenders that are going to be coming very close to that rate and still be able to, you know, kind of get the a similar sort of rate that you'd be looking for anyway. So yeah.
Because something happened with me, didn't it, a few weeks ago?
It did, yeah.
Basically, I had a application going through with a mortgage with yourself. So we had a mortgage application going through, and then the lender came back and said there's a default on my account, on my credit file, and I was like, well, I've not missed any payments. So I started looking into it, and then it turns out that it was fraud. Someone actually took out a credit card in my name, and it was showing as an adverse credit on my file. So I had to contact this like third party and get them to look into it and do an investigation. It was like a formal investigation, and it came back that it was fraud. So someone had used my name.
Was it a credit card, wasn't it?
A credit card, yeah, for like £800.
Yeah, I remember. Yeah. I remember because I said it to you and you were like, what? I don't understand what's going on. And I was like, I don't know how that's even come about. So yeah, it's crazy, isn't it, when that can happen?
Yeah, but it worked. We got it off. Yeah. So now it's like, it should be coming off my credit file now.
But the good thing about that is that, and this is one of the points I'm making about the credit score and all that sort of that stuff, is that even though that happened, the lender didn't decline you. They didn't go where we were going. They didn't go, oh, we're not doing it. They were like, what is this? Can you elaborate a little bit on that? And that's kind of the nicety of using that kind of specialist lender, is that they don't just straight decline it, even though, you know, it's not particularly something that they would like on your file. So that was obviously a good thing as well.
Yeah. What's the difference between a mortgage advisor and a financial advisor?
Yeah, so I mean, a financial advisor can do mortgages. They don't, not all of them do, but they're generally speaking more into sort of investing money, pensions, that sort of side of things. So I'm not saying a financial advisor cannot do mortgages, but a mortgage advisor just does mortgages. That's what they specialise in. My thought is there's so much to know and learn. You can't do it all, you know. So personally, that's just my personal opinion, you really want to be speaking to a mortgage specialist who just does mortgages if you want a mortgage.
Yeah.
And a lot of the time as well, like, we've got financial advisors that just don't have the time to do it, so they'll refer us business. And that works both ways. So like it kind of helps. So they can help advise obviously on the pension side, on, you know, kind of the investment side, and then we kind of come in with the mortgage side, which kind of helps quite nicely. And also mortgages take a lot more time than investments, like generally for a lot. So a lot of these financial advisors maybe don't have the time to be investing into, you know, mortgages that don't pay as much as probably their investments. So, you know, nothing wrong with that. That's just the way that their market kind of works. So yeah, we do get a lot, don't we, of referrals from, you know, good financial advisors that are great, you know, for obviously they're really great for what they do, but obviously they just don't have the time or the luxury to be able to know every intricacy and niche of a mortgage market that is quite complicated.
Yeah. You know, like a lot of people that I mentor, they will come to me and they'll say, right, I've got a broker that, you know, I bought my residential house with, got my buy-to-let with them, and they're saying this, but Luigi, you're telling me this. And I'm like, the thing is, you need a specialist broker.
Yeah.
And, you know, right here, mortgage style, the UK is rated #1 HMO broker. So people need a specialist. When it comes to HMOs, if they try and use a normal broker, I don't think they'll get the deal done in the way they want it.
Not in the way they want it.
If they want a commercial valuation and their normal broker has never done that before, because a lot of them haven't, they're going to be screwed on the end val.
You only get one shot as well with those things generally, and they might pick the right lender, but it's generally not just the lender, it's everything. It's the surveyor, it's the lender, it's the knowledge of who to go to as well, and generally how to place a case. And I think that's evident in the fact that I think the amount of times I heard you say you've come to me for a case and I'm not getting the right valuations, and then not really understanding the logistics of why you're not, and then being upset and kind of disheartened that this is a complete fad, when actually it's not. It's just how it's positioned is wrong. It's like I had a client, I don't know if we can divulge a little bit more about that, but I had a client where they'd come to me a year or so ago, and they got the information from me, but we're talking to another broker and they'd spoken to him first before me. And it's kind of a bit frustrating because obviously they come to you on a referral, they like you and they prefer you, but they're already kind of into the other broker and their situation and what they're doing. And they placed them with the right lender, but it was the wrong time. They went before they had planning. And then they couldn't get the commercial val because this lender only did commercial val 7-bed plus, and they only had 6, and the planning was going to take 12 months. So they got the valuation, wasted thousands of pounds on a valuation that was never going to give them what they want, got a bricks and mortar valuation that was about 450, came to me, we got it revalued at 680,000, and that is the difference. It's huge. It might not be that much all the time, but that is crazy, and that is purely on they losing their kind of will to live with the first deal, coming to me going, and then not trusting me because they'd already done a deal, and then automatically getting their backs up against the deal because they've picked the wrong broker. So picking a broker is like picking a solicitor as well. It's two of the most important things you can do. And if you fail at that, and they generally don't understand, and it is hard, it is really hard to trust that guy knows what he's talking about. But if he hasn't got any experience, smell it, because you are going to end up in a big problem.
If you don't know what you don't know. So a lot of these brokers are actually quite good brokers, but they just didn't know it was even possible to do some of the stuff we're doing. We've got loads of broker firms actually introduce business to us for their specialist side because they know they haven't got the full knowledge of it. And then we do give them a bit of a commission split back on it, but they know then their clients are being looked after properly and the clients getting what they want.
Yeah, 100%. Great points. Another big question I get: should you buy properties in a limited company or your personal name?
Yeah, so I think the biggest thing with limited company, is dependent upon personal tax, and we're not tax advisors. I've got to make that very clear. We're not tax advisors. That is a completely different entity. But what we are is able to give you factual information that hopefully you can use well to buy property. I think the biggest thing that people mistake when they're buying property is if you go in limited or personal is why. What is your rationale? Why are you doing it? And if you haven't even thought about that, you've just gone, I'm going limited. Well, that's not really how you should be looking at it. It should be a couple of prongs of why you should go in a certain way. And the main thing is, how much are you earning? You earning over 50k a year, because if you are, you should be considering looking at limited company, because you're going to get taxed to the hills on that kind of monthly rent that you're going to be getting overall, because you're going to be getting taxed 40% of the overall income. So effectively, that's gross rental as well, not even just the kind of the net income, which you used to be able to get. And because we've lost the ability to kind of get rid of that with the tax changes over the last few years, it kind of makes single let buy to let worthless if it's not going to be in kind of a limited company if you're earning over 50k. Now, of course, some people might say, and again, we can't tailor to everyone because there's going to be so many different things. Some people might say, okay, well, what happens if my partner's earning less than 50 grand? Well, yes, you could, if you're married, potentially be putting some of that money into their name if you're joint owners. But the main thing I kind of say is, well, yes, that's true, and maybe you should use that first. But there are benefits, as Marcus can kind of attend to. Like when you're buying a limited company, you get a lower stress test because you're treated as a basic rate taxpayer, which means that in our cases, when we're doing deals together, because you're doing yours in limited companies, we can borrow more money. So when the rates went really high, that was really difficult for some people where the rent wasn't enough to fit, especially for single let buy to let. So that's a big kind of benefit. So limited company is, it's got its faults, it's got its problems. It's going to be taxed more potentially in other ways, like from corp tax and any money you take out of it. I know you've got the salary that you can take out, but then you've got the dividends that you're going to get taxed on if you take it out. So there are some downsides. You've got more accounting costs, so then again, if you want to use your personal tax allowance, use it first, then do it. But the main thing I think is that if you're going to be a higher rate taxpayer, you should really consider looking at limited company and getting tax advice before you even bother, because that is the main thing. Everything else is kind of irrelevant. It doesn't matter. The other things about limited company that are good are being able to use it to your own advantage, getting money in from other businesses you might own and directors loaning the money in, and different little entity things like that, that are going to generally help. And also not taking the money out and paying tax on it, just keeping it in there, because all you want to do is just, you don't need it monthly, you just want to invest it and keep it in there long term, keep buying properties with it.
That's quite a big one that Dan just said there, transferring money in, because if you've got a self-employed person, then they've got a business, and it could be anything, it could be a carpenter, whatever they do, and they want to take that money out of the business, they're going to get taxed on it. But if you're buying in a limited company, you can do an intercompany loan from your existing business into there, and there's no tax taken off that to get into that company. So it's so tax efficient from that front as well. But as Dan says, we're not tax advisors, so you do need to speak to someone who's qualified in that. But we just know it works for people.
It's just like the little side little bits that you can kind of see from obviously the outside, and obviously personal experience, and obviously seeing other people doing it firsthand as well. But definitely making that point clear. We're not tax advisors; they're just side benefits of obviously doing that. Really, to be honest.
And then just to add on to that as well, like taking it a bit more advanced now, but you've even got the holding company structures, which is something that I love to implement. I just love that, because I can have my holding company and I can have all my different companies, the shareholding as my holding company, and then there's no dividend tax.
Well, there you go as well,
yeah. So, little golden nugget for you guys.
And that's also good as well, like just adding to that point from diversity, because we get questions where some people take it to a different level where they've got like a combination. So they might go, well, can I have a business where I'm a carpenter, for example, as Marcus has said, and at the same time then put properties in that business? Yes, you can. Whether you should do that or not, again, probably should be taking advice from a tax specialist. But then that's different level of complexity, because from that side of things, you get issues with lenders not liking trading companies being part of that kind of scenario. So actually, it might be better to have a holding company that kind of separates those two out and obviously is completely separate from it. So there's loads of different things that you can use, but definitely talk to a tax specialist about that.
Yeah, setting up a limited company is really quick and easy, cheap. SPV, lenders call them, special purpose vehicle, and it's there, just a whole property. And you can set it up in a day pretty much, can't you? And what's it, £250 probably to set up? Yeah.
So this is how I do it. So I'll find the deal first. So I'll go out there, find usually HMO conversion. Before I even come to you with it, Dan, I'll literally call my accountant or message him, WhatsApp. I'll say, set me up this company, please. This is what I want to call it. These are the shareholders, these are the directors. Give him all the information. He'll set that up. Usually it takes 24 hours and then sometimes much quicker, and it's just set up. And then I'll come to you, give you the details, and then from there, what is the process like on your side? So once you've got the details of the deal, what do you do on your side?
Well, I think the biggest thing I'd say before we even get into the deal is make sure you're starting out with a bank account as well. And obviously you testify to that as well. Like, as much as it's great to obviously just set up the limited company, the bank account is a big one that I find that can kind of come back to bite you later on down the line. Because you think it's going to take a couple of days, like your own personal accounts, and then it takes like a month, or you get declined for no reason just because you're dealing in property. So I think that's another one, and making sure that you're going to the right kind of banks, and we can obviously help you out with a bit of experience with that. Marcus can kind of testify for that for himself, but that's one of the things. And then it's just about placing the case, where we're going. Now generally with you it's kind of a lot easier because I know your strategy, your niche, and you're coming to me and it's kind of tried and tested. With anyone new, it's generally about asking them their goals. So before we probably get to the limited company, it's probably about, right, where do you want to go, what are you trying to do, and how do you want to do it? And then it's trying to place the client into that kind of strategy.
A lot of people come to me because they want to do the BRR HMO method that I do, where I buy a property, refurbish it, get a commercial valuation on it. How do you get a commercial valuation on a HMO?
Yeah, so commercial valuations, it's a massive topic. We get asked that all the time. If you go to a normal high street broker, they may well say to you, you've got to have 7 bedrooms as a minimum to get commercial valuation, which isn't the case. We do loads all the time on 6-bed HMOs, even 5 beds, if it's got the right number of bathrooms or en suites. So there's quite a few factors to look at on this. I would say that's a big one, is the number of bathrooms. Lenders really look at that. If they can see it's been heavily adapted, the property, they love that. So they wanted to know that it can't just be easily turned back into a residential home. So the more you've adapted it, more work you've done to it, the easier it is to get a commercial valuation. So number of bedrooms, how you adapt it. You're looking at things like what you're adding in terms of utilities, using washing machines, ovens, cookers, fridges. So a lot of our clients put in 2 of everything in a 6-bed HMO even. So that again is another adaptation. You've got your standard stuff you're going to have to do under the rules anyway, things like fire doors obviously, and maybe bike sheds and what have you. But yeah, getting a commercial valuation from our point of view is going to the right lender for a start, but also, and this is so key, is the right surveyor. Because if you choose the wrong surveying firm, they're just going to value it either as bricks and mortar or hybrid, or just not have the knowledge to know that it should be getting a much better yield to give you that much higher value. So we keep a record of all our valuations that have been done. So we've got a bit of a blacklist as well. So surveyors that have given us bad reports back and low yields, then we alerted to them, and we go to the ones that we know are going to give us good, solid valuations. Yeah. It's harder if it's an area that you haven't done many mortgages in the past. We're based in Bristol, so we know it like the back of our hand, and Dan helps you obviously in Nottingham a lot, and then we are all over the country, but there's still areas that we don't necessarily know. Yeah. But then we can use our knowledge and our contacts to actually find out what yield should we be getting and who are the best surveyors for that area.
It's really quite simple as well. I mean, like blueprint wise, like Marcus makes a good point about obviously the surveyor and how it works. If you're kind of trying to pin it down in terms of a scenario, just because you haven't done an area doesn't mean you shouldn't do it. Like, it's still the same blueprint. It's right, we know what lender we're going to. That's step 1. We then find out the valuers, because we can get quotes from obviously the lenders, but also we can kind of touch base with local surveyors and see what they would suggest. And then it's trying to gauge the market, obviously, from that kind of scenario. So that's kind of the way that we would work it. So I've worked in like kind of loads of different areas now, where it's not just Bristol, it's not just Nottingham, it's Manchester, it's Liverpool, it's Kent. It's loads of different little areas that we've obviously like had little tasters of. Yeah. And as soon as you got that, you kind of know where you're ending up. In reality, the one thing I would say though, is that the kind of the higher up the country you go, the yields are going to get slightly higher, like generally speaking, because the property prices are a little bit lower. But that's nothing to really worry about. Like, just because we're getting like 8% in Bristol or slightly lower sometimes doesn't mean to say that we can't get lower in other places. It's just that categorically they are a little bit higher in some other areas. Yeah. So like that's the other thing to bear in mind. But it's a very good idea of working out whether also the lower you go in bedroom sizes, whether the bricks and mortar actually is better or worse. Because a lot of people will go, I want a commercial val. Okay, but do you even know if the bricks and mortar could be better than the commercial val? Because we've had a few of those, right? Where the bricks and mortar actually was the better option and it was a lower rate because it was a better value than the commercial.
Yeah, and that's ideal situation. You do want, ideally, you don't want to bank on a commercial val.
No.
Does the deal still stack up fairly well on bricks and mortar?
That's
if it does, then you know, yeah, this is a deal to go for.
And it's the better cash flow, right?
Yeah, better lending rate.
Yeah.
And I think that's the main thing I'd kind of look at is like, it's not just about commercial, it's about which option actually generally makes more sense. And the lower bedroom size you get, generally I find it harder to get a commercial val, not because it's impossible, because we've done them on 4 beds.
Done them on 4 beds, yeah.
But sometimes there's a difference between is it worth it? And that's the thing. It doesn't work for everyone. Like for us, it's worked. But for some people, they might go, well, there isn't much of a difference between the commercial and the bricks and mortar. Let's go bricks and mortar to get a lower rate. And they're happy with that, right? Yeah. So like that's the thing. You still might have added significant value. It just might be like 15, 20 grand less.
Yeah. So like just to give the people watching like a live example, we did one recently where we purchased the property for 82 grand and it got valued at, was it 155?
155, yeah.
155. That was a 4-bed HMO. But the bricks and mortar was probably about 110. So it wasn't like a pure commercial val. If we did it based on a pure like 11.5% yield,
it would have been much higher.
It was like 180.
Yeah.
But this came in at 155, which I was very happy with. We only left like 15 grand in the deal, like over £1,000 profit per month, net profit. So can't complain. Happy days.
You didn't have to spend a massive amount on the works either, really, did you, I suppose, in general?
Yeah, that one was quite good. It was quite a cheap renovation.
Yeah.
But one thing, we're getting more 4 beds valued. I don't know. We're going to have to see what they come back at.
Yeah, that's the problem. I'm getting a bit worried about the 4 beds. Yeah. I will say that. I mean, I think that the problem we've got isn't necessarily our expertise and the valuers and the lenders and even you. We know where we're going and we know what we're doing.
Yeah.
The problem we're finding is that a lot of lenders are taking kind of kind of almost pressing advice on valuers to be like, we don't necessarily feel like, that is what it should be worth. And I think that's the problem you'll find, is that, some of the valuers that we have used recently are getting pressure from powers above that are suggesting that those valuations aren't necessarily right or correct. So yeah, that may be more difficult, but the more experience we get and more knowledge we get, the better we'll be placed to kind of make those decisions.
100%. And what I've noticed is, like, the people I've seen be the most successful in property in general, they're always able to pivot, and they don't get down about when things change. They don't just let it bog them down.
No.
They think, right, okay, what changes do I need to make? Which route do I need to go down? Loads of things are always changing in property. Like, we've got the reform changes coming up now. That will affect things. But I wanted to ask you, where do you see interest rates going at the moment in terms of over the next 2 years?
I think it's like famous last words. Like, no matter what you say, like, it's obviously going to sound like great in hindsight. But like, for me personally, like, we've been saying it for a few years, but like the consensus from an economic standpoint is that it will get better. And I think that's very evident by the fact that, especially in the US, markets seem to follow that very, very often. But for me specifically, like, if I'm looking at rates and where they're going, it is lower. It's going to be a slow process. It's going to be a couple of years, and it's never going to get back to where it was before, certainly in the medium term. To short term sort of scenario, maybe in the long term, but certainly for the next 2, 3, 5 years, I don't see it ever getting back down to where it was before. But I think we could all, kind of hope that it's going to end up around 3.5% maybe in the next few years. But again, don't take that as kind of completely kind of evident that will definitely happen. It's just that if you look at it maybe every 3 months and seeing how inflation fares against obviously the country and how everything's going, I think generally rates will continue to fall, but they're going to be it's going to be a slow edge away. And if you're waiting to invest, that's not necessarily the best thing to do. And I think you'll be kind of evident from that. You've gone through the whole kind of cyclical cycle, which is great boom times into obviously recessions. But I think one thing that people forget is that you can still make money even when things aren't looking so great. And once these rates do come down and you've got all these properties, you're going to be in a much better position.
If you wait for interest rates, then what's going to happen with values? They're going to go up.
Exactly.
So is it worth waiting?
And I think that's the point I'd make, is that even though you might not make as much money now, or it might not look as evident to invest now, it's a long-term perspective that people should be taking.
Yeah, 100%. Property is definitely a long-term game, and I always say this to people as well. But I just wanted to ask you, do you think like normal family home buy-to-let is dead?
For the minute, but then again, like, you could look at it from two angles. The first angle would be that yes, generally now it's going to be hard unless the property's at under 200 grand, say, to make much money from the property. And even if I say that value, it doesn't mean the rent's great in the area. The rent's still got to be comparatively pretty decent as well. But if you're looking at like what most people used to do, which is buy a 300 grand house, great for capital appreciation maybe in years gone by, and still making decent money because the rents are really good. Now, the more debt you've got, the higher gearing it's going to be, the harder it's going to be to make any money. Which means effectively, yes, probably for the next 2 or 3, 5 years, you'd suggest that it won't, because unless rents keep catching up to that point, it won't. But what you're going to have now is like a kind of an equilibrium point where they both come back in together with each other, where rates will keep falling, hopefully, and rents will kind of gradually increase, maybe not so drastically, to a point where it will start making money again, but it's going to take time. And that's why it's a long-term gain. And you can look at all angles of, yes, let's move away from that now. That's your pivot argument. Pivot to something else for a minute, and then potentially you can come back to it in a few years' time.
Yeah. And like, say if someone's, they're looking for a property to buy, they might have found a deal or they've got a few potentials. What would you recommend for people to do in terms of if they wanted to use you guys as the broker?
Come to us before you actually go and start looking. Let's get a gauge and a niche of what you actually want to do before you start jumping into something that generally isn't going to be what you want or what you're expecting. Because if we get it too late in the day, I can't do anything about it. If I get it early enough, I can understand you, make obviously an assumption of what you want to do, and then try and gauge and put you together in one place. If you come to me after you've done a bridge, the value of the property was never going to be what you're expecting, and you're expecting me to get you something, our relationship isn't going to start on the right setting. It's going to start on the point of you expecting me to get you something impossible that was never going to happen in the first place. So I think it's setting expectations and then knowing that they can actually come to you for the right reasons.
Yeah, that's the thing, guys. Mortgage Style, they will have your back. Like, you can see it right here. They will have your back. So if you've got a deal, you're about to find one, you're looking, just speak to them, guys. All you need to do is click on the link in the description and give them a call, drop them an email. They will definitely help you. So people, at all different stages, just basically just reach out to you guys and have a conversation.
Yeah, as dumb as it sounds, like the first initial call is probably the most important, and the sooner we can get it, the better. Look, I'm not saying I'm going to waste an hour of your time like looking at something, because we're not. We don't have the time to be like, you know, kind of spending hours and hours like every single minute on every single deal. But what we can do is just prop you in the right direction, just so that just before, and even just when you're looking at property, just send me the deal, just so I can see what you're doing, what's your expectations. Because a lot of people come to me cash as well. I'm like, I can't see it. If you just bought it cash and gone ahead with it, you didn't even tell me what you're going to do. How am I going to know how I can advise you? Like, because I don't even know what you're doing, and then you come to me and you go, oh, it's got an issue with the structural element. I thought it'd be fine. I could take care of that. Well, no, that was always going to be a problem. Or it's under commercial, you know, just some little tweak that we could have helped with before you bought it.
Yeah, definitely.
Getting to speak to us as early as possible is really important, because if you're going to be out looking at properties and you offer on something like Dan said, especially at auction, you're committing 10% on an auction, you don't want to be risk losing that. So we can advise really early stages, is that property going to be acceptable? We can identify what issues there might be. So yeah, just get in touch. And you know, we're not charging you at that point. So if clients speak to us, we're happy to give consultations, and we'll speak to them over the phone, whatever it is, Teams, face to face if you want to see us. But the key is that we don't actually charge our fee until we've got you that mortgage or that bridge or that development finance.
Yeah, no, that makes sense, man.
Yeah.
And you know, Marcus, one thing I noticed as well is a lot of people, they'll buy a property, they want to convert it into a HMO, they actually go ahead and buy it, and then they realise, oh shit, it's in an Article 4 area.
Yeah.
So they need to apply for planning. But the reason why they put Article 4 in is because they don't want more HMOs.
Yeah.
So it's likely to be rejected. So things like that, they can be avoided, but you have to be around the right people.
Yeah, agreed.
You know,
Absolutely.
have the right broker.
That's the biggest thing as well.
Yeah.
So I see a lot of people that kind of come out of that situation, and I had one of those actually recently, and the only way we could get around it is by basically letting to a social housing group, because obviously they can potentially bypass obviously those criteria points. Otherwise he'd have been stuffed. So like, it is really important to have not just one approach but a couple of approaches to get out of those kind of scenarios, which we can provide as well. Because I always say with the social housing side, when anyone does a deal, is, you know, when it comes to social housing, is right, well, does it still work on a single let? Does it still work as a HMO? Does it still work obviously as social housing? As long as you can kind of pivot to a couple within that kind of scenario. Of course, if you do it to a HMO, it's not going to be a single let. We know that because it's already heavily adapted, but it could still be a social housing kind of proposition. And that's kind of the point to raise. You get a couple of pronged elements to it. You can go either or ways, then we can get a way out of it worst case.
Yeah, because I think typically my typical deal now will be I'll buy a property, my plan A will be social housing HMO, or it might be working professional HMO. It's one of the two. And then plan B will be like a service accommodation property. Plan C might be a single let family home. So we'll try and run the different scenarios. So yeah. But I wanted to ask you guys, what is bridging finance for those that don't know?
So bridging finance is a really good tool. It's a little bit like a mortgage in a sense, but it's different in other ways. So you're able to use short-term funding basically to purchase a property that effectively is unmortgageable. In most cases, not always, because you can still do it for other reasons, but there's normally a reason why you're doing that. You're either looking to refinance it and refurbish it, obviously, to be able to do that, or you're basically buying something completely run down, dilapidated, or just effectively like not mortgageable for one of a couple of reasons. It's either got no kitchen, no bathroom. You know, those are the common things. It could be has subsidence, got structural problems. It can be anything really, but that's generally a reason to do it. Another reason is just because you're going to add value, and obviously you want to know what the end value is going to be. And it's short term, it's flexible. You're only paying for the months that you're in, and effectively the cost difference isn't that big to a mortgage now any day anyway. So like a lot of people, I know obviously we don't condone this, but we've seen it. Obviously a lot of people will go down the route of buying it on a mortgage, which again we are not condoning. We just know that people do it. But the main thing I'd say is that the cost difference isn't really that different. When you're looking at the exit fees, all the rubbish that goes into it, as soon as you have timber and damp problems, you're basically going to have to get the timber and damp sorted out before you can mortgage it anyway. So effectively, all those problems are going to come back to kind of bite you in the end. And I think just knowing the way you can go about it to get the end value you're hoping for, because that's the biggest benefit of a bridge, is knowing the beginning and the end value. Yes, okay, it might differ slightly when you come to refinance, but the main thing is you know your direction, you know where you're going to go. And that's the biggest benefit. I know it costs a lot, in terms of generally, if you've got cash, you want to buy it cash, do it. But if you've got a finance need, bridging is the way to go if you're looking for the end value result.
And why do you think people are so scared of like bridging finance?
I think historically people felt that they were getting ripped off, 'cause it used to be really expensive compared to what it is now. It used to be like 1.5% per month for bridging. Now you've got rates starting at kind of 0.59% per month, which again, people might look at that and think, well, that's expensive, but it's not, because you're comparing it with a mortgage, which you can't get anyway on a lot of these deals. So it's a means to an end. So we say to people, look, if you put in all your numbers together, like you would with the materials to build that property, and it all fits and you're making a good profit at the end, then it doesn't really matter. You wouldn't be able to do it without that bridging loan. So it works.
Yeah.
If anything, I find it safer than buying cash or buying in any other means. Not from a monetary standpoint, but just because, one, you can spread your risk because the lender's looking at that property before you're even buying it. They're looking at it for their own interest, of course. They're not looking out for you. They're looking out for them first. Is the property going to be refinanceable? Is it going to be, mortgageable in its current state? What's the problems? Are there any conveyance on that property that are going to cause issues? All those things that lender's looking at, maybe not for your benefit, for their own, to make sure they can resell it if you don't pay it. As long as you're getting someone like that looking over your deal as well, that's good. A lot of people look at that as bad, but that is a good thing because you know where you stand.
Yeah. I think when I started out, I used to look at bridging and I used to think, I don't really want to do it. This is my very early on, because I used to think, right, what happens if we don't refinance within that first year? Will they just repossess my property straight away? Obviously, that's scary.
That's it. I get that.
But we can bridge a bridge, you see.
Yeah.
So if someone's really struggling, either, first of all, you go back to the lender you've got the bridge with and you say, look, can you extend this? And a lot of them are actually really good and they will extend it. But if they won't, then we can go to another bridging company and they bridge it again and you've got another 12 months. So there's always ways around it.
You just got to be proactive with your with the lender you choose. Like making sure that, with any deal that you're with, you're letting them know what's going on, sending photos, making them aware of obviously the deal and where you're at and the progress you're making. And look, not every deal is going to go to plan. It is going to take longer with some deals, but as long as you're making them aware of that, then fine. But I think the main point is the more deposit you put down, not just focusing on trying to put the least amount of deposit down, the more you put in, the more money you've made in the deal. Therefore, if you need to extend the bridge, you can, and you can get away with that as well.
Actually, to add to that, Luigi, people don't realise, a lot of people, that you can actually get 100% or even more than 100% of the purchase price with bridging if you've got additional property. And a lot of people, even if they haven't got another buy-to-let that they own, they may own the main residence that's got equity in it, and they can take a second charge on that to give you the money to buy the property and even give you extra money on top of that to do the works to it as well.
Yeah, it's like I did one the other day where the client was buying his first HMO and we used his main residence basically against the HMO to fund it. He didn't put a penny down.
I think he's on my training program.
Yeah, so that's the thing. So there are examples where that is feasible. A lot of people don't know about that. They think that the 100% mortgage thing is or bridging thing is rubbish, but it isn't. You can do it. It just depends on what assets you're lucky enough to have. If you have something that you can use, we can do it. Second charges against those, or even first charge if they're lucky enough to have no mortgage on them. I get it. Not everyone has that, but it is a nice tool to have. Or if family have got a property that they're happy to put a charge on, those things can really be a leg up.
100%, and it's about being creative.
Yeah.
And, again, I just want to tell people, just have a conversation with you guys at Mortgage Style, because everyone's situation is different. And I feel like that's one good thing I've noticed with you guys is that you will look at people's situation, have their back, and actually advise them. You don't just give out general advice, what a lot of brokers I feel do.
It's trying to nuzzle in to find something that's useful inside a deal. I generally find with most people, it's not going to work for everyone, and you have to make that very clear. Not everyone can get everything. There are going to be things that sometimes people have got to break down the barriers to get over time, or make money to get the money. But if you do have something, we'll nuzzle it out if we can.
Yeah, so just touching back on commercial valuations on HMOs.
Yeah.
How does the valuer typically calculate, how much they're going to value the property for on a HMO commercial part?
Yeah, it's quite confusing because when you talk about yields, which is what they're basing the valuation on, certainly for myself, when I used to look at property investing, you hear about, it's got a great yield, that property, and that means the return's really good on it and the percentage is high, so you associate high percentage yield with a good return. But the way they work it out, the surveyor, the lower the yield percentage, the higher the value of that property is going to be. So what they'll do, you have a property, they'll look at your rent you get on that property, and they'll multiply that by 12 months, your monthly rent, to give you a figure, and then they divide that by the yield percentage that they've given you for that property, and that exactly gives you the value of how they're valuing that property. So you can work that out yourself. If you know what the yield is that's given on a particular property and you know what the rent is, you can work out what value that will get on a commercial valuation.
Yeah, yeah.
And if you don't know the yield, we can find the yield out, basically. That's the point I'd be making in terms of the areas you're looking at. Everywhere is different, and as we said and touched upon earlier, there are some areas that are better than others, and that's evident. But if you're generally working on, sort of an 8% yield, probably best case in most scenarios, I know you can get slightly lower than that, but we're talking kind of in Article 4 areas and alike, that's generally probably the best case in some areas. But other areas that could differ, that could be like 11.5%. It's completely different areas, so you have to make that clear, but that is a good way of obviously being able to work out roughly what you're looking at. And some valuers might even take off bills, some don't. It really just depends on obviously the areas and the valuers, but that's where it comes back down to. Stop trying to do it yourself and start looking at a broker and obviously yourselves to help to kind of package that deal up.
Yeah, because I can say like in Nottingham where I invest, I know that if I've got a property in an Article 4 area, it's a 5-bed, 6-bed plus, in terms of the amount of bedrooms. I know we can say we'll be looking about 10-11% gross yield. So the income gross yield, not like a net yield where it's just the actual profit that the property's making. The gross yield, we'll be looking to get it valued about 10-11%. If it's outside of Article 4, it becomes harder to get a commercial valuation. It's not impossible because we do it a lot. We've even had it on 4 beds. Is that going to carry on? I can't guarantee that it will. Fingers crossed it will.
Hopefully, mate. Hopefully.
But the ones that are like outside, of Article 4, it seems to be like they don't use that kind of calculation and they just kind of give you a hybrid in between. So it does get a bit more complicated. I just want people to know. It's not always set in stone.
I find like generally the spectrum is massive. Like, I've seen some as low as like, Marcus has got some low, I think you've got one below 7% once, but like.
I want that.
That's like Bristol mainly, but like we've got like other areas where I've seen them go up to like 13.5%. The spectrum's huge, but it's area dependent. And I think that's the big thing to kind of realise is that you're not going to get them specifically at a really low value unless there's a reason. Either you've got planning for it to be a 7-bed, that is going to increase its value significantly. But the second point is generally where is it in the country, and the third point I find also with that is kind of really how much work have you done, how much adaptation have you done to that property as well. And as long as you know those things, it's quite easy to be able to kind of at least put you in the right direction.
And one thing I have noticed as well, there's a lot of like developers, HMO developers in like Derby, for example. They've got a really good valuer, but I don't always think it works in their favour because sometimes they'll get like a 6-bed HMO valued for like 700 grand or 650, and the bricks and mortar value might be like 300 or 250. So at that point, you don't really want a high val because you're over leveraging yourself, and that's something I've always been conscious of. We got a super high val on one of my ones recently, and I had to speak to my business partner and say, look, it's good that we got a high val, but we want to drop the LTV slightly.
Just to make cash flow, wasn't it? I mean,
to make more cash flow.
Yeah, and I think that's the point that people forget sometimes. Is that it's all well and good saying, look, I'm going to keep leveraging yourself to the hills to be able to buy these properties, but you don't want to over leverage yourself, and you certainly want to make sure that it works for you and your business partners or whoever you're involved with. So, I think that's kind of really important, is having that kind of, you might get the great valuation, but do you need that, or can you deal with a little bit less so that it's a little bit safer in the long run?
And the other thing about that, the luxury is you usually get a lower rate as well on the mortgage, because if you drop down to a lower tier, like if you were going to borrow 75%, but you said, I'm only going to need to borrow 65%, then usually there's a cut-off there that you get a better rate as well.
Yeah, that's good. So I'm just going to ask you guys, could you explain LTV? Like, what is LTV, just for the viewers that might not know that term? Because it is a bit of like not a buzzword. What's the word for it when it's like a jargon term?
Jargon definitely. Yeah, I think there's a lot of those things.
Yeah, abbreviation,
There's a lot of those things kind of buzzing around. I think the main thing with loan to value is just to understand that it's basically the value of your mortgage against the value of the property. And as long as you understand that, you get it.
Well, layman's terms, it's loan to value.
Yeah, exactly.
That's the basics, it's loan to value.
Exactly. So like whatever your mortgage is against the value of the property, and you basically divide them by each other, and effectively there you go. And the maximum generally for most lenders with HMOs or even standard properties can be up to 80%. I've seen it higher before. It went to 85. It's come down obviously since then. That's more bricks and mortar values, if we're being completely honest. But obviously that's divulging into a slightly different point. But the point is, the lower the loan to value, so you go in 75, 70, 65, 60, and as you go on, lenders can offer better products. There is a cap to that. Generally, it's 60% and below. You aren't really making much of a difference. And if I'm honest, it might not even be much between 65, 70 really anyway, to be honest. But it's still, if it's slightly lower, putting in slightly more deposit or leaving slightly more capital in the property, you get a slightly better rate.
Yeah, so say you had a 100k house, got valued at 100k, your loan to value is 75% loan to value, you've got a mortgage on that property for 75 grand.
Exactly.
Yeah.
Yeah.
So when you've got a lower LTV, your monthly payments are lower.
That's it.
Yeah.
So that means you make more profit per month.
Yeah.
But if you're refinancing like what I like to do, you'll be pulling out less capital from the deal.
And that's the catch-22, isn't it? It's working out what works best. Is it better to keep a bit more in? If you're a bit more flush with cash and you can deal with that, then do it, because you are going to benefit in the long run.
Yeah. And this one's for you, Marcus. Why did you start Mortgage Style? Can you give us a bit of background about, like, you know, how you got started, the reason why, that kind of thing?
Yeah, sometimes I question why, but no, generally speaking, it's been good. It's been a while. I think it's 18 years ago I actually started it in a back bedroom. Well, just the spare bedroom. So basically just stuck in there and then finish work and crawl to the bedroom and go to bed and start again. And it was hard work to start with, but yeah, I've been doing mortgages quite a long time, and I just felt that I could do it a bit better than where I was. That I was restrained by the rules of the companies I was under, and we just wanted to be able to offer everyone a mortgage, a solution, and try to never say no. So there's lots of brokers will just look for the easy route, and they say, if that looks like hard work, I'm going to say no, we can't help with that, and move on to the next one. Whereas we'll really got tenacity, so we'll stick to it and until we find a solution for a client, and that's what I want it to be like, and that's what it is like. And as you know, dealing with Dan, he's like a dog with a bone, you know, he won't let it go.
He'll find a way.
Yeah, exactly. But yeah, so we started off like that, just in the bedroom, as I say. We built up, we've now got 12 staff, we're recruiting for more, we want to keep growing, we want to keep working in this field. We do all types of mortgages, as Dan said at the start, actually, you know, first time buyer stuff, but we love the landlord investment stuff and seeing the results that landlords are getting and building portfolios and stuff like that. And the specialist side, it's really exciting.
A bit more fun, isn't it?
Yeah, it is, yeah. And so keep growing that, really. And
Well, you know what? I think having the right broker on board, like as part of your kind of power team, is definitely crucial to success. Like, I 100% agree with that. So, you know, in terms of the biggest deal that you guys have done, in terms of acting as a broker for, what was that like? How big do you guys go?
Yeah, well, Dan can cover his, but for me, I did a big deal in the centre of Bristol. It was 65 flats in a large building, centre of town. The client wanted to borrow 27 million. I think the value in the end was about 48 million for the block. So yeah, it was complicated and it was quite long-winded, but yeah, great to learn that side of it, dealing with those bigger cases. What about you, Dan?
Yeah, basically, I think the biggest one I've ever done is just like portfolio refinances, because like property individual vals, there is a ceiling, right? I mean, most people aren't doing like buy refurb refinance on like £8 million deals. Do you know what I mean? Like, it's generally going to be then flipping and selling them. So I think the biggest thing generally I'm doing is generally like, you know, sort of up to 10 million plus, but that's generally like portfolios as like all properties in one. And I think some people don't realise that as well, because you can put all your properties in one mortgage together and basically take them all as one. You know, if you get to a certain point, you're kind of happy with what you've got, put them all together in one place, get a commercial val on all of them, for example, if they're, you know, or not if they're single lets, but on the ones that aren't, for example, and put them all in one place. So that's probably, you know, one of the most challenging things for a broker, because you've got so many different valuations to deal with at the same time. But yeah, that really, I guess. But That's probably the biggest deal I've done to date.
Yeah. Are you able to share numbers on like the
Yeah,
size and
like
stuff?
so, like the value of the properties. I think it was roughly about 10 mil, and I think it was roughly looking at about 65% loan to value. Because the bigger you get as well, like you're looking at like kind of like a lower proportion that you can borrow against those kind of values. But generally, I think it was about 6.5, 7 million roughly.
Yeah.
And then it was just looking at refinancing that. I think they were capital raising about 2 million to then buy more properties with that at the same time, because they kind of gradually built into their portfolio as it went by, and then use that money to go and buy some more HMOs and crack on and go again.
Yeah. Do you guys ever have it where you have a client and, you know, they want to raise capital, and basically you'll help them speak directly with one of the lenders, and you'll get like I don't want to say a credit line, but the lender might say, yeah, we can give you, say, £2 million, that kind of thing. Because my friend does that. He's saying I need to look into it, kind of thing.
Yeah, to an extent, yeah. I mean, it used to be available more commonly in the past. To an extent you can. Like, we've got a few clients who've got very big portfolios, and they do have, it's not a credit line, as to say, you just give us a call and we'll drop the money into your bank account, you know, tomorrow.
So a few people ask me, they've said, right, I've got a property and I want to convert it from either a residential home that they've bought on a residential mortgage, or it's on a buy-to-let mortgage. They want to convert that property into a HMO. Talk to us about that, like what would the process look like? What's the best way of doing it? That kind of thing.
If you've got a buy-to-let, generally, let's just say, for example, it's just a standard single-let property. Yes, in theory, you know, you could have your own money and you could technically do it, you know, with a mortgage, but we can't condone that, because lender, you'd be breaching their rules, their regulations, etc., etc. So if you're talking bluntly in terms of how you should be doing it, you should be getting a bridge if you need to do that, and obviously then potentially funding it through that bridge. They can take over the charge that you've currently got over it on the mortgage at the moment, and then basically use that to then either draw some further funds if you need to, for example, to be able to then do the works, or if the works are a very small amount, then trying to fund it yourself, either through a personal loan or effectively just in general from your own sources, or a business partner, or whatever that kind of looks like. But that's generally how you could do it. It's a bit harder with the residential, because generally speaking, it becomes regulated, which is harder, still doable, but effectively it would be a similar process. You just basically take the property, come to us with it, let us have a little look at it, see how much you need to do the works, etc., and then effectively look for the best option from there.
And then refinance it at the end, obviously, onto a proper HMO mortgage once the works are done.
Yeah. Definitely easier if it's a buy-to-let than a residential to do that, because, as I said, the regulated element being your place where you live is a bit more difficult for a lender to kind of want to do that.
Yeah, but let's say someone had a residential house. One thing they could potentially do, let me know if this sounds legal. They've got a residential home, they do the works, make it into a HMO, they apply for a license on it, but they don't let it out. They just keep it there, they make it HMO compliant, and then they approach you and then try and switch it to a HMO mortgage. I don't know, I'm just trying to think.
Well, it's because if they've got a mortgage on it, it'll be a residential mortgage, so they're breaking the terms of the conditions of that residential mortgage if they change it to an HMO, because you're changing the usage. So the official line is, yeah, you're kind of breaking the terms of your contract with the mortgage provider.
Look, we know people do it, and at the end of the day, like if you're doing it without our knowledge and you do it, well, then we can't condone it. You shouldn't do it. Yeah. Like, you should come to us, obviously, first and foremost. I get your point. It's very creative, obviously, because you're not actually letting it out. But I think that the point I'd be making is that just be careful with what you wish for. If a lender obviously finds out, they can obviously tell you to pay them back and leave them. And, you know, obviously technically it's mortgage forward, but look, at the end of the day, I think that the main thing I kind of look at is, as long as we've discussed the options, then obviously then we can look at the best solution.
Yeah. So it's down to people to, you know, like, make the right choices, do everything by the book is the best way.
Yeah, and definitely don't let it out, you know, unless you've got permission from the lender beforehand, because, you know, it will come back to bite you eventually.
You could get blacklisted, and then it stop you getting finance in the future on other stuff.
All lenders talk to each other, and they all have systems where they know that people obviously do certain things, and you can be put on a register for those sort of tactics. So just be careful what you wish for. Yes, it might be good for one deal, might make sense for one deal, but does it really do you really want to risk your future over one deal? And the answer should be no.
Yeah. Have you guys got any like horror stories, you know, in all the years that you've been mortgage brokering? Is that the word, mortgage brokering?
Yeah.
Yeah. I mean, the biggest thing I find, like with mine, are things where people have come to me and then it's become a horror because it's been a horror beforehand, and I've now got to sort out someone else's mess. And I think that the main reason for a horror story is because of poor preparation and planning. Kind of the preparation to actually do a deal and make sure it actually makes sense is the most important thing in the world. And I think you obviously kind of condone that. You come to me before you do a deal generally, we'll have a little chat about it, but now you know your niche, you don't really need that, you've got free reign. And it's not me saying I've got to put like a collar around you and obviously know what you're doing on every deal. It's just knowing that effectively that is going to work in the way that you envision it to work, and then there's no problems. Like the problems, there's still issues that can be there that we got to iron out, but they're small things, they're things we never could have anticipated for, and they're problems that effectively can come about, but we didn't know about them. So I think the main thing from a horror story perspective is people coming to me and going, I'm expecting a 400 grand valuation. They get a 300 grand valuation. And I've told them that, effectively we can try it, but I very much doubt, and I'm honest, I'm always honest in that sense, and hopefully you can vouch for that.
Yeah.
I'll always say, look, if I don't think it's right, as condescending as it might sound, I'd rather tell you now than let you down when you need it at the end. So I think the biggest thing for me in terms of horror stories is that, or timing. I had one deal that took 14 months because the guy had to get the title registered. It took so long to be able to do that. It was ages. I mean,
Was that like a refinance? 14
Oh
months?
no, it was a bridge, just to get a bridge on the client's deal.
Just to get the bridge?
Because the person that owned the property had sold it to this person, never registered the land, it was registered incorrectly. That person bought it cash, funnily enough. That solicitor didn't realise that. It took us that long to track this guy down that was living in a van somewhere in Wales. And then effectively, and I mean a van, they had to get a private investigator to find out where he lived because he'd gone off grid. And then after that, try and get it registered, then go back to him a few times to get a few more forms signed, and then wait for land registry to kind of register it. And yeah, you could have gone elsewhere, but when you get that far into a deal and you spent that much money, obviously it's hard to get out of a deal when you're in that. So I think timing's probably the worst. I mean, that's very special. Most cases don't take that long, but probably time is the biggest horror, or valuations because it's not prepared for.
I think it's bad luck on a few clients. They've bought stuff, not got planning, or suddenly Japanese knotweed has been discovered, and you've got to treat that, and there's time extensions because of that.
Yeah.
We've had some landlords who've unfortunately found that their properties have become marijuana farms, and without the knowledge, things like that, which is a bit of a nightmare, obviously.
Yeah.
But yeah, generally it's what Dan said, really. It's unforeseen sort of circumstances, unfortunately. Yeah, or not preparing for what could happen.
Yeah, I thought there was an interesting one. What we did was basically we had this property, 6-bed HMO, non-Article 4 area of Nottingham. We was expecting, a decent val, and we just got downvalued 2 times because we tried with one lender, one valuer. They downvalued us massively. We went with a different lender, got a different valuer out. They did the same thing. It was slightly better, but it was still pretty crap. And then the third one gave us exactly what we wanted. And then we used that valuer again and again and again. So I think one thing people don't realise how crucial having the right valuer is.
And sometimes you don't get it right first time, and that's generally like the rule. But as long as you generally learn from that, and you think, look, that's not what I know I can get or what I think it should be. It's about that's why Marcus was saying it's so important to have the right valuer, because that is really important. Although you can't always have that valuer, it's knowing roughly where they sit. So that you know that that's where you're going to be expecting to be. Yeah. And that's whether a deal works or not.
Yeah, ideal situation is someone's investing in an area and they've got a good broker like you guys that can say, right, we know this area and we've got a couple of valuers that have been giving good values in this area.
That's it.
So,
and having diversity of choice is really important, because you might have a good valuer today, but they might have an issue tomorrow with the way that they value it and stuff like that. But also that's mainly for commercial. We're not talking about bricks and mortar value properties here. For 90% of those lenders, they're going to have Connells or eServe or whoever it might be that are going to be specific to that lender, or they might have their own internal valuers, but generally you can't say who they use. They're just going to use them every time, and you either want to steer clear of them or you want to go with them because you're getting bricks and mortar anyway.
So valuation packs and buying like flowers or gifts for the valuer. What's you guys' thoughts on that? Do you think it's work?
I think it does work. I don't know. I don't know about the flowers or the chocolates. Depends what they like. But yeah, certainly we've got clients who looking for commercial valuations. They produce this pack, really good research. I think the key is how you position it to the surveyor, because they don't want to be spoken down to and trying to be
Yeah.
have their words twisted or their thoughts. And so you really want to be saying, look, I've done lots of research. I really just want to give it to you to show you
Yeah.
what I've found. Hopefully, it will help you with your report. But yeah, personally, I think on those types of valuations, it really does work.
You're trying to benefit their job and make their life a little bit easier by providing good information, not like information that's never been there, or it isn't there, or effectively like just speculation. Do you know what I mean? It is basically, I've seen that property that's been sold and it was this time and this price, etc. Not that might sell for that and this will sell. Do you know what I mean? It is generally specific. So I think that's the main thing I'd be making, is that as long as it's clear and concise. You don't need to be 30, 50 pages long.
Yeah.
Just a couple of things to help them, obviously, on their way. But certainly don't be bribing them.
A couple of 50s drop out of it.
So what are the current rates that people can expect for like a normal residential family home that they want to live in themselves at the moment?
Depends on loan to value. All of this, so going back to the same point of how much money you're putting down against obviously the value of the home that you've got. The more you put down, the better. So generally speaking, like if you're looking at spectrums, if you're 95%, that's the highest generally. There are some little schemes, I'm not going to get into those because they're a little bit more kind of specific about like basically how you can put in maybe like £1,000 or £5,000, to deposit instead of obviously the full 5%, but the genuine kind of rules are 95, 90, 85, 80 and so on, and they go down as that kind of comes about, as we spoke about before. That's residential, so obviously it's going to start a little bit higher, but the rates generally probably over 5 for that, 95%, and then coming down slightly if you want to go to the lowest end of that spectrum, probably under 4s now for a 5-year fixed, around 3.7 I think is the lowest. Obviously don't quote me because I'm not, this is today, and obviously it might change tomorrow, but they are coming down gradually, and I think that's the main thing. I think they've come down like nearly 1.5%, something like that, roughly in the last 12 months or so. So it's a gradual reduction, but if you want specifics, then obviously come to us directly. HMOs, we can probably kind of say between bricks and mortar and commercial. Everyone's going to be different.
Before you jump onto that, I just wanted to just ask on this one. So with like a residential house that someone's living in themselves, we're looking, say if they put down like a 10% deposit, are we looking roughly about 5% interest rate?
For 95 probably, for 90 probably somewhere around 4.5 to 5, somewhere in that kind of spectrum. And again, it depends on, I don't want to kind of pigeonhole someone to something because although that might be a starting rate, and I'll make that very clear, it could be higher for specific reasons. And that might be income they earn, how much they want to borrow, what debt they've got, so many different dynamics. But if you start in at that point, I'd say that's starting point.
Yeah, okay. And then with HMOs, so we're talking, most people that watch the channel, they'll be looking at getting commercial valuations. So we've got a property, HMO, on a commercial valuation. What kind of rates are we looking at for working professional HMOs?
Depends on your tolerance to fee, and I think that's really important because there are some crazy deals out there that have got like 7-8% product fees, some even more than that. Look, there is a place for that, and the place is that if you're really struggling and you need the money out of the property for whatever reason, then maybe that is the only route and the only way to borrow the extra money, because the lower rate means you can borrow more money on a 5-year fixed, especially with buy-to-let. So effectively, it may make sense, but for me, the sweet spot is generally around 3% as a product fee. And if you're going to be looking around that kind of level, then for a working professional, if you're looking at bricks and mortar, if it's just like a 6-bed val, maybe something around 5.2, something like that. As a best case, 5.3 maybe, with a slightly lower fee maybe as well. But for commercial vals, it does significantly increase. If it's a 7-bed, you're going to have more lending options, so you're going to be able to go with a lot more lenders in that pool, which means you could still be looking around that kind of rate. But if you're looking for specific valuers that are going to be valuing the properties at smaller than 7 beds, then you're probably looking at, depending upon our exclusive deals that we get, probably something around about 6.1 for like something with like a sort of a 3% fee, maybe like 5.6 or around that level for like a 5% fee. So it depends on your tolerance to fee, but I think a lot of people get put off by the 5% fees because they are huge, and when you see it compounded for 5 years, it's a lot,
What Dan said then on exclusives is quite important because we do a lot of business, especially in this arena. We get a lot cheaper rates than other brokers, or if you went direct to the lender. So an example there, on a commercial valuation on a 6-bed, if you went to, I'll just give you one example of a lender, Shawbrook Bank, they charge you 6.84% for a 5-year fixed rate. We can get that for 6.14, so that's 0.7% lower. did a quick calculation this morning, and on a £500,000 loan, will save you £17,500
which is crazy.
over another broker who can't get access to that
Is
deal.
that per year or?
That's per over the 5-year
That's the
period.
5 year
Yeah.
deal, so it's
Still,
not-
it's a lot of money though.
Yeah.
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 And obviously, the more you borrow, the better as well, because obviously the lower rate means you can borrow more money. So obviously it might not fit stress tests in some scenarios, but that can make a world of difference to making a deal fit for cash flow, but also for the money you want to borrow from it.
Yeah, but I think you guys touched on the best point here, which is it's all down to people's circumstance. What are they looking to achieve? The first thing you said you asked them is kind of their goals.
Yeah.
You know, when someone reaches out, what are they looking to do?
And a lot of brokers don't do that. Like a lot of brokers just go, "Can I help with that deal?" And it's like a kind of a transactional thing. Whereas for me, it's like, "How can I help breed you into obviously what you want to be?" I know that sounds weird, but do you know what I mean? Yeah. But I think the thing that's going to get clipped up now, isn't it? But I think the thing is that if you've got goals to be something and you're just going to do a deal that wasn't going to recycle that money, but you didn't even realise, then that's really important.
Yeah, 100%. So, what kind of trends do you guys see? I know you guys speak with a lot of people. What are the current trends that you see people that are wanting to get into in property right now?
I think we've touched on it quite a lot. It's just the movement in terms of, everyone always like 5 or 6 years ago just wanted to be in single let, buy to let. Like just generally because it's easy and it made sense. Like no one wants to do hard stuff for money. In the day, you want to do the easiest thing you possibly can. If you've got a landlord that's built 10 single let buy to let properties all worth 100 grand and it was easy, great, 25 grand each one, it made sense, it was making decent money because the cash flow is great. I think the steady trend is towards more complicated things, and that has its kind of issues, because if you don't know a lot about everything, then you come into more kind of issues coming forward. So I think that's the biggest thing, is just moving into more complicated things like HMOs, semi-commercial, Airbnb, just all those things that have kind of basically come about really since COVID. Holiday lets, more things like that, more people staying in the UK when they go on holiday. So I think that's the main thing, is just moving in different senses. But I like your kind of analogy really of pivoting and being able to move. So I don't want to circumvent a client. If I do a deal for a client, I want to know that it works as a working professional HMO and also as, I know, look, it's an ideal world, but also as a social housing side, because you can pivot between. And if one doesn't work because it's not giving the rent you're expecting, you can move back to the rest. So I think having that kind of idea in the back of your mind is great, but the trends generally are to more complicated things.
Yeah.
And that's where we come in, really.
Exactly. For me, what I'm doing loads of is conversions, standard houses to 6-bed HMOs under permitted development rights. So we'll fund it with a bridge for the purchase, get the works done as quickly as possible, so you're paying as little interest as possible on the bridge, refinance onto an HMO mortgage on a commercial valuation, pull the money back out and do it again.
Yeah.
And we've got clients doing that all over the place. The struggle, they're actually just finding the property. But we've got landlords doing leaflet drops.
Yeah.
Say, look, I'll buy your house
Same.
for you. Yeah, exactly. You do it, Luigi. Yeah. They're even using property finders to help them, all sorts. But it is still really big. And if you're looking at Bristol, for example, it's a big student town. So a lot of these places are easy access to universities and stuff, so you've got those on the doorstep, and there's too much of a shortage, at least in Bristol, for student accommodation, and I think that's the case over a lot of parts of the country. So yeah, that's a really popular angle.
Yeah.
I think the trends for me as well is diversifying your portfolio structure. So like, just because HMOs are great now doesn't mean they will be forever, and the same goes for obviously single let. Yeah, it might not look great now. It's not a bad thing to have a couple of single lets up your sleeve at the same time, because if rates do fall, they might suddenly become really profitable again.
Yeah.
And the same goes for social housing. Although it's great now, doesn't mean it's going to be great forever. Right? We don't fund it. They're funded obviously in different means. So those contracts that are given aren't always the best. So yeah, it just depends on obviously who you're going with and what you're doing, and making sure you're doing a bit of everything. I think that's a really good flavour.
Look for the opportunities around you as well. So an example is the university campus in Bristol is expanding by 3,500 pupils, and that's going to be in the next few years. So now people are looking at where that new campus is going to be, what the properties close to that they can then put students in. The other one, there's going to be a big arena built in Bristol, and so we've got other clients looking at properties around that area where they can do short-term lets, so Airbnb for people coming for a concert for the weekend, and they can house them. So it's all sorts, really.
It's just like knowing your area and just making sure, like, you know your niche, making sure that you know it well enough where you can go, that makes sense and that fits the bill with what's needed in the area. Because it's all well and good investing in an HMO, but if the social housing providers don't even need it in that area, it's pointless. And secondly, if there's no universities or any kind of professional lets needed nearby, what's the point?
Yeah, exactly. And you know, I get a lot of stick online and flack online for people saying that, you know, I'm part of the housing crisis, I'm taking away, you know, homes, buying them, making them into HMOs, where a first-time buyer could get them and live in them, which I do understand where they're coming from. But the thing is that due to the tax changes, it's very hard for a landlord to buy a family home and rent it and make profit.
Agreed.
It's very hard to do. So that's why I think the trends change more towards like high cash flow strategies like, you know, Airbnb, HMO, social housing, because it's just not working that well for landlords buying family homes.
Yeah.
And the interest rate's gone up now, it's even harder.
Yeah.
So that's kind of where I see it. It just doesn't make sense for me, for example,
But then
to do single lets.
There's trends in different ways. Like you make a really good point there. Why, you know, obviously there's a shortage in main homes, and taxation is the biggest one. Like the amount that we're taxed, obviously, to be a landlord nowadays, whereby rates are obviously compounding the other side, and you're going to make no money from it. So that's the first problem that you're going to face. And obviously, you know, HMOs are a growing trend, but that's of people where they want to live, younger people as well. So like saying you're taking away a house from other people, you're actually providing 6 new places for in a 6-bed HMO for young professionals to live together in one house. And that isn't your fault. That's, you know, down to the fact of having a housing shortage and obviously understanding the market. People can't afford to live on their own in one place, especially being a young professional, because it's too expensive.
Yeah, exactly. It has a trickle-down effect.
Nice.
So, yeah. But yeah, in terms of a HMO, if someone wants to, you know, get a HMO mortgage, what are the typical requirements that they're going to need?
So the biggest thing when you're coming to obviously buy a HMO property is having experience. Like that is really helpful. So having at least a year's worth or 2 years worth of buy-to-let experience is great. Earning 25 grand is also great, as we sort of touched on before with the other sort of deals. And also owning a house is great. But they're not the be-all and end-alls. That's just niceties, as I think I pointed out in the prior point. But the main thing is, if you don't have those things, you can still get a deal. The lowest amount of things you could do is you could just buy a house with no experience on a bridge and then effectively refinance it with no experience. And if you do that, then you can actually still buy a property with no experience at all. And actually, probably only a couple of grand's worth of income, because those lenders don't have minimum income requirements. Again, it's just a pleasure to have, and it makes it easier for us and you to do a deal, because you've got more lenders, more choice, and get better rates. But if you wanted a bricks and mortar valuer or even a commercial valuer, it's possible. You just have to bear in mind that there's less lenders. And until you actually kind of come into buying one, you're never going to break down those boundaries and then be able to provide, obviously, more options for yourself and better rates going forward. So you can basically do it with no experience or anything. It's just where you get to the 7-bed pluses that it becomes a problem, and you may want to JV with someone if you want to do that as your first deal, because yes, there might be a lender that does it, but are they going to give you a commercial val? And that's the biggest problem. And it's all well and good saying you can do a deal, but if you can't get your money out of a deal, is it really worth doing it? You know.
But yeah, to be honest, I think we've had a really good conversation today. I feel like people watching are going to get a lot of value. Hopefully they was taking notes, because we dropped a lot of info, but we'll have to do this again. And thank you guys, you know, for today. It was really good.
Thanks, man.
Great, no, thank you, Luigi.
Yeah,
Good to chat.
Yeah, and guys, remember, if you want to speak to Mortgage Style, all you need to do is click on the link of the description of this video. All their details are on there. They're ready to speak to you today. Remember to like, comment, subscribe, and stay tuned for more content.